Please nod your head if you can hear me.
Good afternoon.
Okay, great, great. A very warm welcome to everyone, to our panelists, and to everyone who's attending this session. My name is Wambui Chege, and I am the independent chair for Making Finance Work for Africa. I will be your host for this session today. I am also joined by my co-host, Monsef Klush, from the Arab Bank for Economic Development, as well as a distinguished panel from the international development world and the private sector. Could we move to the next slide, please? Great, thank you. So let me start a little bit by introducing what Making Finance Work for Africa is. It's an independent initiative that is hosted by the African Development Bank in Abidjan, Cote d'Ivoire. Although right now we're all working from home wherever we are. It's a platform for joint action, for dissemination of ideas and coordination between donors and stakeholders in the African financial sector to address development priorities in the sector. Next slide, please. So before we proceed any further, let me just acquaint you with some of our housekeeping rules. We're going to have our webinar today lasting for about 1.5 hours. That's how much time we've budgeted. And all participants are going to be muted for the first 40 minutes while the panelists are speaking. We want to ensure that we have the highest quality experience and also that we go through the session and then after that, open it up for questions and answers. If you come up with any questions during the session when the panelists are talking, please put them in the Q&A box as well as the chat. The team will be monitoring and we will be able to answer them after the session. Then all slides and recordings will be circulated to everyone who registered after this event. Please message the Secretariat team. If you have any issues, you can message them directly and you will see them indicated by their names, specifically host. And please don't forget to fill out the survey that appears automatically after the webinar. Next slide, please. So I'll take just a few minutes to introduce what this session is really all about. So I was reading somewhere that the COVID-19 pandemic can be referred as the Black Swan event of our times. The unfolding of the pandemic in the first half of the year took many businesses by surprise, and following the implementation of lockdown procedures affected the way we live and also the way we work. And for many businesses, it has been a really, really tough period, with many of them not able to trade or even do business during this period. It was against this background that 8 multilateral development banks and trade development institutions engaged with the banking community in Africa to gauge how the sector has performed so far during the pandemic. A pulse check was conducted in the first half of this year by June and with various financial institutions. The findings were really, really interesting and in some aspects, not as terrible as we imagined. Today's panel is going to discuss some of the main findings of the Pulse survey. And more importantly, the panelists will also highlight what they think should be the main priorities for the development banks over the next few months to support the trade finance market, as well as to support the financial sector in Africa so that we can keep economies going and get businesses back on their feet. I'm going to now introduce the session panelists. We are joined by Monsef, who is a senior advisor with the Arab Bank for Economic Development in Africa, in charge of developing the private sector and trade finance operations. He has over 25 years in top-tier consulting across the Middle East and Africa. Representing the development finance sector are Mamadou Ba, who is Trade Finance Officer at the African Development Bank. We've got Ian Sayers, who is the Senior Advisor, Access to Finance at the International Trade Center. We've got Mubarak Elegbede, Head Trade Finance Department, International Islamic Trade Finance Corporation, and Andrew Asira, who is the Head of Operations at the East African Development Bank. From the banking industry, we've got various representatives. We're joined by Nuru Mugambi, who is the Director with the Kenya Bankers Association, Sebastian Ashong Katai, who is a group head, financial institutions and international organizations at EcoBank. Theobald Sabi, Managing Director, NBC Tanzania. Last but not least, we are also joined by Jane Warambo, who is CEO of Envisage Limited, a women-led social enterprise based in Kenya that exports fruit and vegetables. Without further ado, I'm going to hand over to Monsef. Please take over and let's have a very interesting panel discussion.
Thank you, Wambewi. Thanks for the introduction and welcome to everyone that has tuned in to this webinar. We're delighted to have you on the session on trade finance in Sub-Saharan Africa. I'd like also to thank our distinguished panelists for accepting our invitation to participate to the session. And without further ado, as you see on the screen, I'd like to introduce the agenda for today and the key questions we'll try to address during this an hour and a half. So the idea is we will try to structure our conversation along three main topics, scheduled for about 15 minutes each, essentially. So to make time for everyone, just as Wambewi was saying, we're quite a large panel. I will try to restrain from asking follow-on questions, but hopefully we can catch up during the Q&A session if there's any additional interest or any question we haven't covered fully. So, so back on the agenda, we'll first try to take some distance from this literally extraordinary year and hear from practitioners on the ground, entrepreneurs, corporate, etc., on the impact of the pandemic on their businesses, but more specifically on trade finance and the ability to continue their trade and continue being able to provide supplies. Second, we'll sort of switch focus towards the bank and try to understand, because they are on the receiving end, they're the one providing finance, trying to understand what some of the pain points that they've been facing, what are the difficulties, what are the what we call the pain points that they've faced. And finally, the third section would essentially turn to governments and MDBs and understand what can we do in the short term to continue the support they've been providing so far. What can be done in a very pragmatic manner to make sure that there is continuity in the trade across Sub-Saharan Africa. So without further ado, if I may, I'd like to first address the first topic of the day and the situation of trade finance from the perspective of entrepreneurs and commercial banks. The practitioners have been facing the first wave head on and with an unheard shock of both supply and demand at the same time. So it'd be interesting to hear. Obviously, we cannot generalize these insights to the whole continent, but it'd be interesting to see, to hear at least some particular experiences and some particular feedback from these individuals. So we had initially Mrs. Jane Warambo. I'm trying to see if she is connected. Yes, you are. Mrs. Warambo, greetings, good afternoon. Thank you for making it to this panel. I hope you, I hope you can hear me. Can you hear me okay?
Yes, I can. Thank you.
Perfect.
Yes, I can.
Excellent. Mrs. Warambo, it'll be excellent if you can kick off this discussion and especially give your business side of what happened during the first crisis, especially how this crisis has affected your business, but more specifically your ability to access trade finance. Was there a sudden credit tightening? Did you halt all your current transaction? And most importantly, I think, how did this situation evolve and how did you adapt and learn from this COVID-19 world? Over to you, Mrs. Warambo.
Okay, thank you very much. Like you have heard, I manage a company by the name Envisage. It is an SME, specifically in agribusiness. We primarily, the primary product we do is we are in the avocado value chain. mainly for export. But as we deal in fruit and vegetables, we also trade in the local market, supplying fruit and vegetable to institutions. But primarily, our biggest business is built around exporting, and the highest demand product is avocado. We are just under 5 years old, and our growth has been highly supported by ITC, and we are the few companies that fall under a program called Markup. Okay, they provide capacity building, strategy for growth, access to marketing. Now, towards the end of last year, we had prepared ourselves perfectly for financing, put together our plans, looked at our strategy, and had spoken to financiers. Now, the avocado export business in Kenya season starts in March of this year. So we had spoken to we have been engaging in market access, and many customers were willing to work with us from the beginning of the season and were just about to give us the commitments. Now, there were two things we were pursuing, the commitments from the customer as well as the financing from the finance institutions, because we really needed the working capital to scale our business. And as you all know, COVID then happens in March, and specifically our season starts on 15th of March. And as you all know what happened in the middle of March. So here we are, the customers have now told us to hold back on orders, and the financial institution, and at the other year end, the financial institutions are telling us that they need to have a wait and see approach. They are not onboarding, they are not taking in any other financing obligations. So that totally disrupts the business. And at the same time, the local trading for horticulture, which we do to institutions, mainly hotels and schools, are also shut. So all the income that we are hoping to receive, some on a weekly basis, then goes completely lost. Now, as the COVID situation progresses, there are some export customers willing to exploit some market opportunities, and they spoke to us. But unfortunately, we were not able to service this business because we need pre-shipment finance. Now, if you cannot even get the working capital finance at the later part of the supply chain, pre-shipment finance is a complete no-no. Yeah. So, well, it then means that we have to let go of most of these opportunities at this stage. So our capital crunch was even made harder during this COVID period. And as an SME, we are facing the challenge of looking for pre-shipment finance, because everybody is expecting you to pay cash, and yet you pay cash for your inputs, your packaging, and yet all your customers are expecting you to extend them credit. Yeah, so that becomes a major challenge, only compounded, of course, by the COVID situation, and not all those institutions understood the export business for them to actually take a chance on you. So really, that is how it affected us. And as the market started picking up, the demand for the products started picking up, and the market was growing. Then the competitors also came into the scene, because we have other country competing for the product, and so the product even lost in price. And so we were really unable then to participate in the trading at the time, A, because of financing, two, because the demand
Prices.
was lower. Yeah, and so there was a major disruption to us. But we have spent time improving on our standardizations, improving on our certifications, yeah, and preparing for the new season in 2021 with the faith that we will have sorted our financing position and the institutions are more willing to listen to our situations. But the biggest risk that we foresee is that our cash flow statements now do not look very healthy. And then now we really expect, an understanding from any institution willing to bet on a business such like ours.
Excellent. This is, thank you so much, Mrs. Warmboy. This is obviously a sobering view from what happened. We really hope that the things will look up, and in fact, it'd be interesting to actually see or seek the input of Ms. Mugambi on this, Nuru Mugambi. She's part of the Kenya Banking Association, so she probably have a good perspective sort of on the other side of the stick of what happened on the supply side, but also how they have adapted to the situation, very similar situation, I'm sure, across the patch that you've heard from Mrs. Warrenbo. Miss Mugambi, good afternoon. If I can ask you to unmute and share your view and maybe respond to some extent to some of the concern that you've heard, and I'm sure they're not unique.
Sorry, I see my computer saying that my internet is unstable. I don't know if you can hear me.
Yes, we can.
Okay, fantastic. So thank you so much, and thank you all for this invitation to just share some thoughts about how we are seeing COVID unfold from a banking industry perspective. Just very much like Jane had mentioned, we started off the year from a domestic economic performance perspective. We started off the year on very strong footing. So when you look at Q1, wholesale and retail trade output compared to last year's Q1, you see that we were at a better position this year. So therefore, when March happened and the events that unfolded within the agri sector, of course, in avocado and other sectors, as the events started to unfold, you realize that we were starting on a solid footing, which was, I think, good. But of course, COVID happened, which affected and restricted trade. We saw our clients having higher input costs, higher debt obligations, not only because of their businesses, but also because of personal commitments. In Africa, not only here in Kenya, actually each individual not only supports their own household, they support up to 6 different households on average. So you realize that COVID really had a cloud over not only our businesses, but also our households. And what we saw within the financial sector was the need to renegotiate contracts, a need to provide moratoriums on certain lines of credit, to adjust fees. The banks waived payment fees. They fixed interest rates. Of course, this was in conjunction with the central bank that really played a key role in really advancing good monetary policy, sound monetary policy through consultation, as did the government. The government of Kenya, as many African governments that we noted, Ghana, South Africa, really moved swiftly to really learn quickly from China and Italy and the West. And therefore, a lot of the fiscal policy measures that came in helped really cushion. Of course, unfortunately, as Jane was kind of sharing with us, the trade sector was the hardest hit. When you look at the number of loans restructured, the number of moratoriums offered, it was really the trade sector that was taking up a lot of this activity. Banks in Kenya restructured as much as 1 trillion shillings worth of capital, just to give you an example. And then, of course, the non-performing loan portfolio continues to increase. It's actually at an all-time high. We're almost getting to 18, 19% NPLs within our portfolio. But with that said, we feel that the monetary and fiscal policies that I mentioned earlier actually have helped ground and anchor where we are. And I think we are beginning to see in July, in the numbers that were coming through reported by Central Bank in June this year, we're beginning to see trade pick up a little bit. So we're hoping that this trend will be sustained. So we're seeing an uptick in trade. And others, I guess, complementary sectors, I could say, like transportation, that really supports the trade sector. We're seeing a bit of a rebound, not a bit, actually, it's a marked rebound that we are seeing. And then, Motlef, let me also mention that there are green shoots. So it's not all a cloud, okay? So you know how clouds are. Clouds don't cover the whole sky, right? Clouds happen in pockets, yeah? And you have some light clouds, some heavy clouds. So it's not all the same experience within the trade sector. So there are green shoots, for example, within flour exports. We saw flour exports in September go up by as much as 40% when compared to last year. Tea is also doing better than it did last year. Coffee and chemicals, you wouldn't even know there was COVID. So therefore, it's a mixed reality. And really, just in summary, I think what we are finding is optimism is improving because we're recognizing how traders are able to negotiate and navigate this environment. So therefore, we're seeing more optimism coming through. And therefore, I have this term called the COVID kairos. Kairos is a window of opportunity. So we are seeing a COVID kairos where traders like Jane are now they're reinventing themselves, they're having a greater appreciation for operating in a digital way. They're having a greater appreciation for having data, greater appreciation for moving from being in the informal sector to being in the formal sector. I think this conversation around the need to be within the formal sector is an easier conversation now. And then also conversations around gender. I think from a policy perspective, policymakers are now thinking more about why we really do need disaggregated data on gender, so we can really see and understand these economic stimulus policies that we're bringing in to support SMEs. Is there a difference in terms of the owner makeup? So I think maybe I'll just touch on that and really say that it's a tale of two cities, really, where you do have some pockets where there have been some struggles, but at the same time, there is a COVID kairos where certain traders are really doing well, and therefore, even the banks are having greater optimism. If you look between June and September, there's greater optimism within the financial sector in terms of the fact that we're able to withstand what's going on, provided that we're able to control our COVID numbers. Thank you.
Excellent, Ms. Mugambi. Thank you for trying to lift up a bit our spirits. I appreciate it. This was a very interesting perspective. I'd like to just, if I can, sort of rebound and ask Mr. Andrew Asira. Good afternoon, sir, from EADB. You've got a unique vantage point, Andrew, because you extend line of credits to banks, but you also lend directly as well. So you can see both ends of the supply and demand. Would you mind pitching in and sort of providing your own perspective on half year 2020 and how, most importantly, you see this evolving and how this matching of supply and demand could better work in Sub-Saharan Africa?
Thanks, Mons. I think East African Development Bank is a very, very interesting story that I would like to share with you. So when the pandemic set in, we were in the middle of negotiating for line it ourselves, where we get funded and then we onward fund. So the immediate reaction of our funders was to withdraw the proposals that were on the table and price up. So that's what hit us. Fortunately, we were in a very strong liquidity position, so we managed to slow down the negotiations, hoping that as people get to understand more the pandemic and the solutions coming out, the situation will get better. And indeed, that's what has panned out. I mean, they all increased pricing. They increased pricing by on average, about 300 to 350 basis points. But now we can see they've come off somewhat. We're seeing lower pricing, not at the same levels as it was before the pandemic, but we're seeing about 150, 200 basis points higher than it was. So effectively, that means that the transmission mechanism of our credit will reflect higher pricing as an issue that we need to contend with in this COVID and even post-COVID environment. And then back to the clients that we support. As Monsef mentioned, we support projects directly, but we also support SMEs through lines of credit to financial institutions and other national development financial institutions. So to the direct projects that we deal with, the worst hit were the ones in the commercial real estate, almost complete shutdown. Leisure and travel, as you know, almost complete, really complete shutdown. And then the educational institutions. And so a lot of the work we've spent doing has been around restructuring, rescheduling. And when you are trying to reschedule credit to us at an education institution, so we first started by saying, look, you'll resume repayments in September. And then come September, the institutions are still closed. So now we've projected again and said, let's pitch around February, March. That's when they probably can begin to repay. So you can imagine the challenges that we're going through from a liquidity perspective. Now, there were also those projects that were under implementation. A lot of them were relying on foreign labor, for instance. A lot of them are relying on supplies from other countries. All that network was shut down. So there was a complete slowdown in the implementation. Now, for those ones, we can afford to sort of grandfather them and wait until the situation improves. And we can begin to see the situation improving. The labor lines are opening up. The inputs are beginning to come in. So it's beginning to be an issue of patience and working at it, but the delivery schedules, the timelines for those projects will not be met. That's something that we've got to contend with. And then there is another category of clients that are the national development financial institutions, the ones through which we reach other SMEs, we reach other borrowers. Now, these ones faced a very unique challenge where their national governments asked them to restructure to support clients. So effectively, they would face a liquidity challenge, and then they will come to us and say, because we've supported our clients, you also have to support us. And that's what we've been working on. And then the last category are the clients through which channel funding to support SMEs, especially in the agricultural sector. These are the commercial banks. Thanks to the effort that the governments in the region put together in supporting commercial banks and ring-fencing them, and I think Nuru has already captured this very well, we've seen a lot of stability with those institutions, and we didn't see much in the way of structuring their debts. The challenge that we've seen with them is the slowdown in the uptake of our credit facilities. And when we engage them, the feedback they give us is that, one, the business is struggling and the risk factor is very high. So there's a tendency for them to say, let's wait and see before we support. And then there are those that to some extent are beginning to have challenges around raising more collateral that these financial institutions are asking for in a way to manage the credit risk. So that's another issue that we need to really pay attention to, that there may be liquidity coming through, there may be credit appetite, but the appetite is in a way subdued by the fact that these institutions are now asking for more collateral because of the heightened risk. So in summary, that's what we've seen in the market. Again, it's not all doom and gloom. In the agri sector, we've seen a lot of projects coming through, especially in agro-processing. Food consumption has continued to be important. And therefore, through this sector, we are now beginning to see a lot of applications coming in. The key question is whether we will be able to support them in the same way that we did in the past. Are we going to ask for more collateral? Are we going to price up? And there's another issue which I think we need to think about in finishing, which is a lot of those SMEs are relying on one or two individuals or family members as the promoters, as the people running the business, the people who understand the business. Now, quite a number of them are senior citizens, and God forbid if they got infected by COVID, who will run that enterprise? What are the succession plans that they've put in place? In our part of the world, these are things we normally don't want to think about, but I think it invites a lot of discussion. So what if the leading person was infected and is hospitalized? Who will run the business? So these are some of the emerging issues that we had not thought about in the past. Thank you.
Absolutely. Thank you so much, Mr. Asir. Andrew. Very insightful conversation. Again, also very sobering, but hopefully with a glinter of hope. This is a perfect transition, Andrew, because we sort of discussed demand, but partly you already raised some questions about supply as well, supply of trade finance and the perspective of banks. So maybe this is the time to actually switch gears and go to the second topic, which is actually looking a bit more at the banking community specifically, and asking them how they've seen the demand evolved and how they've responded in themselves to the situation, and what are the main constraints, what are the main obstacles that they feel they have right now in terms of providing or trying to provide finance to the situation the three of you described very accurately. So maybe I'd like to invite Mr. Theobald Sabi from NBC to join and share his views. Good afternoon, sir.
Good afternoon.
Good afternoon. If you could just, again, you've heard those stories from the ground, from the demand side, to some extent also from banks. What was your initial sort of reaction to the situation, and how, most importantly, how have you adapted and rebounded to be able to continue lending to the different folks that we've heard about? Over to you.
Thank you. Good afternoon, and greetings from the National Bank of Commerce. We are a significant provider of trade finance locally, but also for imports and exports into Tanzania. I think for us, it's been, as a financial institution, it's been more of a can-do attitude to keep the economy and trade moving. So starting with what we saw in terms of the response from the Central Bank of Tanzania, I would say it's been an excellent response, which ranged from providing guidance to the banking fraternity around how to keep supporting customers during the pandemic, as well as making sure that the banking sector continued to be liquid for the banks to continue to provide the much needed finance. I would say that private sector credit continues to grow at around 5.5% year on year, which is quite healthy under the circumstances. We have not seen a deterioration in terms of demand for trade finance. If anything, we've seen an increase of that, but I will shortly talk of some of the challenges that we see. So I think starting with the challenges, I think the first fundamental challenge was the deterioration of the credit quality of the beneficiary, of the trade finance beneficiaries, mostly driven by supply chain disruptions. So, for example, delayed deliveries of goods into the country and all of that, I think led to a deterioration of credit quality, sell-side challenges around collection. For example, we saw a number of our customers complain of challenges around collecting their dues from their debtors. But from a Tanzanian perspective, we did not see much of a lockdown, but however, being part of the global economy and most of the countries being in a lockdown, we saw an impact to the performance of the companies in Tanzania, and mostly those within the MSME sector. But the other challenge that we saw is just the adaptability of these companies to adapt to working digitally, especially those in the SME and micro SME sector. So that was mostly what we saw from a challenge perspective. But because of the overall global economic situation, we did see that property prices came down, and that made it quite difficult for some of the borrowers to provide the needed collateral to support the trade finance facilities that they normally require in terms of the lending regulations. So I think looking at it from an international perspective, I would say much needed support is required around confirmation limits for international banks to keep these limits available for African banks so that we can continue to support international trade, as well as the need for credit enhancement arrangements, so credit guarantees, for example, given the credit deterioration that we've seen from a COVID perspective. But as well, we do believe or have seen that in some cases, a number of new products that were coming into the market, for example, within the distributor and supply chain area, for example, a number of those schemes were delayed because of COVID. But we do see those actually coming on board as we speak. So I would say that in a nutshell, financial institutions are, as well, we're still open to business. You know, we've taken a can-do attitude, all right, and that we should be able to find solutions for customers, because the demand for trade finance is still there. If anything, it's gone up, all right, but obviously our customers, especially within the SME and MSME segments, do need a lot of support. But if we work together, you know, we should be able to solution for this and keep trade flowing. Thank you.
Excellent. Thank you, Mr. Sabi. Very interesting conversation. I'd like to turn to Mubarak Lakbede from ITFC. It's interesting because ITFC has had the double challenge of answering or helping governments face this economic, social, health crisis, and as well gave a lending hand to the private businesses as well, private banks. Mubarak, welcome. Would you mind sort of pitching in and trying to give your views on what you've seen from the banking community, or that you've tried to help? What were the main pain points for them, and how are you trying to address those?
Thank you, Monsef. Before I start, just a slight correction to the title. The head of trade finance is actually the person I report to. So my work is not that challenging. I just manage a smaller portion of the trade finance portfolio, which is the Africa and Latin America portion of the business of ITFC's trade finance portfolio. ITFC, the International Islamic Trade Finance Corporation, is a trade finance entity within the Islamic Development Bank Group. So essentially, we do trade finance covering about 57 of our member countries. For the portfolio that I manage, essentially mostly Africa and Latin America, has about 27 of those 57 member countries. Now, speaking specifically with regards to the pandemic, it's more or less the same experience for everybody. We all started with expectations of the year, and then something else happened. So at ITFC, what we did, what we thought was prudent to do was to be able to support the current client file. So essentially what we were able to do was to be able to listen to our clients, to understand from their perspective how they saw this pandemic and how they were going to manage it from their side. This allowed us to be able to find customized solutions. So there were many things, mostly were uncertainty from the side of the customers as to what's going to happen. Them being repaid, how do they keep the lights on, and all of those kind of challenges. So from our side, what we thought was the best to do at the time was to find a way to stick with the clients that we already have. So, so our response to that, to the crisis, was essentially partnering with those we already have. And we sort of, like most people, kept new business at the back burner. So for our immediate clients, we understood that they needed some support in terms of keeping liquidity going and be able to then provide their services to go, as you know, our clients essentially governments, sovereigns, financial institution, and to a smaller extent, the SMEs. So we managed to immediately put in place some quick support intervention, which we call the rapid response initiative, which was to give them some sort of liquidity to keep their business going. And we put in place a second plan for the recovery. That is the one that just kicked in with the Q4. This response is supposed to help the economies of this country and our clientele to recover. So for the immediate response, what we did was to provide immediately financing for our clients to meet their needs. Fortunately for us, we're in a market segment where we finance what you call critical sectors of the economy, primarily energy, agriculture, food, and to some extent, financial institutions. So for the energy, as you know, most people were home. People needed to keep the lights on and such like. So we were able to find some convenient structure to keep the energy flow going with our clients. Also for food, Africa, as you know, is you have a lot of our citizens in the agricultural sector. Now, despite the challenges, there were some harvests already done, and people needed to at least get some of their commodities for food security and what have you. So we were able to provide some considerable support during that period for those clients to keep things going. And by the numbers I have, between March till about September, we're able to disburse somewhere in the region of $500 million for these support purposes. So that's what we did. Going forward, we have a plan which was brought about by our management to do like a reset or a re-strategy, to re-strategize, especially with regards to the needs of our member countries. So what we have done with them is to say, going forward, we are all not certain exactly how it will pan out. But the good news is we have a better understanding of what may be coming. So we are preparing ourselves, and we are not doing it in isolation. We're doing it with our member countries and our clients to see how we will together try to navigate what may be coming, because as you know, it's still not so totally clear. But like one of the other panelists mentioned, the good thing about it now, we have some new opportunities, especially for us in the health sector and to digitalize and to bring quickly to the table some new products that are in the pipeline. So some of these are ongoing, and my belief from my side is that they will all come to fruition faster than we had anticipated, maybe because spurred by some of the effects of COVID. So that's what I have to say. Thank you very much.
Thank you, Mubarak. Very, very interesting conversation. It's actually quite fitting that I'll turn to my good friend Ian Sayers from ITC now. Ian has got quite a keen interest on supporting SME development in general across the world, but especially in Africa. And we know this is all the more important right now, and it's probably a very tall order to support the sector right now. Do you want to give Ian good afternoon? Sorry, Ian. Do you want to give a quick account of the discussion you've had with trade finance providers, just like Mubarak was saying, so trying to understand what was the problem there in terms of being able to serve their own customers, the SMEs, but also maybe the larger corporations, and what they've done to cope on the ground? You need to unmute, Ian.
Right. Thank you, Monsef. Okay, good afternoon, everybody. And for sure, yes, look, in ITC, we also need to have a bit of a positive frame of mind, because as you say, we believe in development of the SME business community and its contribution to clean trade. So we're looking at this really from the perspective of some of the numbers and the feedback that we're getting from our enterprises in the field. So I'd like to start by just to inject some of those additional numbers, which are beyond the pulse check report, I know, but just to give an idea of the scale of what we see as an opportunity, a financing opportunity for those of our banking colleagues on the panel this afternoon and in the audience. So, for example, if we're working with approximately 2,000 exporting SMEs across Africa and many thousands more micro entrepreneurs, and let's take the 2,000 exporting SMEs, if each of those are looking at short-term trade financing, the sort of thing that Jane was talking about in the introduction and that Nuru referred to, they're looking at financing needs of maybe a couple of $100,000 to $500,000, $600,000 to get a shipment going, to get their people, their employees back in the business, to buy things in advance, the packaging, the label, get new certifications, because they've found a new market or they can pivot to a new market. So if you multiply that out, you get to a sizable number. Now, admittedly, that's across a large number of countries that we don't have the monopoly on exporting SMEs. So what I'd like to really pitch and to find out more about is what could we actually do as a community around this table to find ways to actually reduce what we see as some of the risks and start to work on finding a solution that will aid the recovery of these SMEs. And maybe it doesn't need huge amounts of money coming into it, but maybe we can see risk from a different angle. And there's two other aspects that I would like to bring into the conversation here that have been opened up to us over the last few days. And one is the dramatic acceleration in digitization amongst our enterprises, entrepreneurs in African countries, and also their logistics providers and other people in the supply chain. And at this stage, I just give a quick plug to a report that's coming out from our good colleague in the WTO, Emmanuel Gan, in 2 weeks' time, which looks at this acceleration and what it could contribute to improving the flow of trade financing to exporting SMEs and the collection of this data that we all find so difficult to get hold of. And then finally, of course, the final component of all this, as all of you have said, it's about the quality of the credit and the quality of the applications or pre-qualifications of the SMEs that are looking for financing. So this is really where ITC can play a role, of course, in upgrading and working through our business development services in the countries to upgrade the quality of the financial management and the presentation of enterprises that the banking community receives, so that it makes people a lot more comfortable and freer about providing financing. So I'd actually like to stop there on a question, Moncef, for our banking colleagues. Do we have any figures around the non-performing loans, let's call them that for the time being, for actually short-term financing? Have we been able to segregate that out anywhere so we can see if that's moved at all off of its kind of normal 2% level?
Yeah, I think it's Ms. Mugambi who had mentioned quite a few numbers on the NPL and the degradation of.
Yeah, sure. Unfortunately, Ian, the numbers I have from the central bank aren't broken down at a product line perspective. And as KBA, we have not done a recent study to really understand the different product lines in terms of breaking down the NPL portfolio. We just have it by sector.
Okay, all right. Well, I mean, of course, yes. What we have heard from some sources is that as several of our colleagues have mentioned, there's been moratoriums on payback periods, which automatically kicks people into the non-performing loan status, but not necessarily the defaults. And some of those figures, like you say, could relate to longer-term loans. So perhaps there might be somebody in our audience that might be able to shine some light on that. Look,
maybe if I could, Ian, I think what you're uncovering is this new learning and appreciation I think that the sector is having in terms of really understanding their client and really tracking the data around that. And I think we're moving from a KYC, like know your client, to our KYC, really understanding, really knowing your client. So really understanding why they're with you, what product they're using, when they use the product. Like Jane obviously knows her seasons very well. So I think financial institutions, because of the compressed margins, are now probably taking more time to really understand their data. So hopefully this time next year, we'll be able to have more clearer numbers at a product line basis, industry-wide.
That's really refreshing to hear. Look, I mean, you know, we also have other examples from IT-enabled services sectors, for example, that are really seeing a huge demand, and they've had 3-6 years of banking experience and are still finding it difficult. So they're still facing 20% or upwards of 20% pricing on 3-6 months advances against orders from really reputable buyers. So you know, there's a lot of hope and a lot of green shoots out there, and they're hurting at the moment.
Yeah, absolutely. Thanks, Ian. Very interesting. Thanks to the three of you. Actually, let's bring in the third, you know, big actors in this, which are essentially MDBs, and see what they can do along with governments to help smoothen the situation, try to help banks have access to credit so that they can themselves lend back not only to SMEs, Ian, I guess the whole industry is suffering. So I guess they'll need across the board to think of, as Ms. Mugambi said, is that RKYC? I'll have to keep that expression, to really understand how they're hurting, especially in this completely unconventional situation that we all living through. Anyway, let me maybe switch gears if Wambui is okay with that. We're running just a bit late, but I think we're okay on timing directionally. Hopefully we can add a bit of optimism and solution to the situation, and I want to focus maybe on the future and what can be done. We know MDBs have an essential role to play in trade finance. We know from the latest report from the African Development Bank that was published, I think, back in June or July, I can't recall. But we know that banks across the region are increasingly relying on MDBs for access to funding. But not only that, also risk-sharing arrangement. We talked, I think it was Andrew who talked about credit enhancements that are needed, or maybe it was Mr. Savi. But it would be interesting to really see now a bit we are in Q4 2020, to really think through maybe with Mr. with Sebastian Ashonkatai, and also with Mohammed Uba from the FDB, to really think through maybe some of the lessons learned from this pandemic, and what are the short-term pragmatic things that have been put in place by MDBs, or there are things that are still missing that would be useful to the industry, as we said, large corporate, governments, SMEs, and microfinancing, women empowerment fund, etc. So I think across the range, there is a need for answers. We know governments are doing what they can. We know the banks as well. We heard from them. It'd be my pleasure to hear first maybe Mr. Ashonkatai. Greetings, sir. We've had
Thank you very much
on the state of the industry over the past couple of months, and what urgent measures would be needed to enhance the response, to better the response, especially from an MDB perspective, or central banking and government perspective. I think we'd all benefit from your insights and vantage point from the battleground. So over to you, Mr. Ashonkatai.
Thank you very much, Monsef, and good afternoon to fellow participants and esteemed attendees. Just before I jump into the topic, I'd just like to comment on what Ian and Nura were talking about. Obviously, the non-performing loan trends will differ from country to country, and the levels will differ. But if you use some of the increase from major trade financiers as a proxy, you will notice about 50 to almost 200 basis points increase in pricing, which is a bit of a reflection of the increase in cost of risk that these lenders expect as the pandemic continues to unfold. Back to the main point that you mentioned, certainly in terms of the programs that we think should be fast forwarded by the multilateral development banks that we work with, liquidity is always important, and that should not be stopped. I would certainly encourage them to continue to do that. If you want to be able to support SMEs the more as well, I would also suggest, perhaps looking at infusing more of the local currency liquidity products as well as the foreign currency liquidity products, because very often the SMEs, unless they're exporters, can't actually tolerate the FX risk that's involved. It's also a great thing to see quite a number of the institutions coming out with shorter tenor products as compared to their typical longer term products that are meant for project and capital expenditure. Now, I think where the tires really hit the road, and I'm quite sympathetic to when I hear Andrew speaking about the fact that even where there is liquidity, some of the commercial lenders are still reluctant to lend, is simply because of the perceived risk, which in many cases is a real risk. So we see some of the multilateral development banks now unfolding risk-sharing schemes where not only are they providing liquidity to banks, but they are actually coming out and also putting their balance sheet behind risk-taking. And that makes it a bit more, it makes it cheaper from a cost and a capital perspective for the financial institutions to lend, and it makes it less risky for them. So I would encourage the MDBs out there to certainly continue to develop this product. In terms of the sort of calibrations that we should see, I'd like to speak more about this risk-sharing product. So typically, an MDB would go out to a commercial bank and engage in a risk-sharing agreement with them that would then allow them to lend to their customers without necessarily demanding 100% of collateral, because part of the risk is being covered. But there is also another level, because I know that there are some financial institutions who are also unable to access sufficient credit from the MDBs for the same very reason that the MDBs themselves are not able to reach all the financial institutions. So I work for EcoBank, and at EcoBank, for example, not only are we lending and supporting the corporate names within the market, but we're also supporting financial institutions. So we have a business that actually supports financial institutions in the trade finance world as a correspondent bank and as a confirmer and funder of LCs as well. So to the extent that multilateral development institutions are also engaging in guarantee and risk share programs with institutions like us, we are then able to provide support not only to SMEs and corporates, but also to some of the other smaller banks across the African region. And that has a pretty magnificent multiplier effect if you actually think about that chain. We also would love to be able to see some of the MDBs coming together in terms of being able to share due diligence and to be able to join together in the products that they provide within the market. This is something that we have seen amongst, for example, the European Development Finance Institutions. The Association of European Development Finance Institutions is pretty good at this, and they do that from time to time. And it would be great, for example, to see the EADB combine with the African Development Bank or combine with ITFC in a partnership that rolls out risk-sharing programs across Africa, where each institution does not necessarily need to do all the work multiple times over. And that would really be great. And then I think that we should also look, at least if we're looking to support COVID strongly, at taking a little bit more risk as MDBs. The typical risk-sharing program looks at, you take 50% and I take 50%. We need to maybe graduate it out a little bit. And then we also need to perhaps look a bit more closely at some of the countries that have become countries that some of the MDBs and commercial banks, if we're honest, are a bit shy. If you look at countries like Zimbabwe and in Zambia, the ability to obtain MDB cover in some of these countries, it looks like it's beginning to sit on the shoulders of a very few institutions. And we might want to look at, how that can be spread out. And this sort of collaboration is something that can really help. We've also seen significant attempts, which is good, by MDBs to support governments across the region. And those governments have in turn rolled out various types of programs to protect the populace. And in some cases, they've been able to give the banks certain regulatory concessions that then allow them to do some rescheduling. But I would encourage the MDBs, whilst it's important to make sure that the governments are well oiled, to also become a bit more aggressive on the private sector, because in many cases, the private sector is able to reach institutions quicker and reach people quicker, especially as many of these institutions and persons are already customers and built into the ecosystems of the financial institutions. And then as we partner with the various governments, we're able to actually make a real contribution to the support of the economies during this time. In terms of things that we're seeing that we think are working nicely as well, EcoBank ourselves, we have a partnership with the African Union's NEPAD, for example. NEPAD has a 100,000 SMEs initiative, and we're partnering with them not only to provide financing, but to be able to support them from a managerial and a strategic perspective. I heard Andrew speak about the fact that some of these institutions are practically run by one person, and there's a risk that when that person goes away, then lenders are worried about these sort of things. So we're looking at them from a holistic perspective in that partnership. We also see Afri-Exim Bank working together with the United Nations Economic Commission for Africa to roll out a program focused on food and critical medical resources during this COVID era. And that's great. And, you know, not only in Africa, but even abroad, we see institutions like the European Investment Bank also rolling out a liquidity plus risk sharing facility to be able to support institutions. And last but not least, the African Development Bank itself, which is a great partner of the EcoBank Group, are themselves also doing significant work in this area, providing liquidity and risk mitigation cover. So I'll just stop there for now.
Excellent. Thank you, Sebastian. This was very interesting, and beyond your point about the guarantees and the need for a different risk load, if you want, with the MDBs. What you said about the further collaboration is between MDBs is music to my ears. I hope this report that we have done is not the final product. Hopefully, this is the start of getting. Obviously, there's already a lot of coordination happening, but maybe we can foster greater cooperation, greater collaboration, greater communication, at least at the research level, trying to get those stories from the ground and trying then each of us then to adapt to the response. But there's a base ground that I fully adhere to in what you just mentioned. So thank you for your contribution. I know we're running a bit late. I'm mindful of the time of everyone. I do have Mohamedou from the African Development Bank that's on standby. Mohamedou, the floor is yours now. If you could just essentially as well, you know, bring us forward towards the future, towards the solution, to you know, bring a bit of optimism to that whole conversation of how MDB could essentially help banks, but also potentially directly SMEs in further developing in business continuation, despite the persisting doubt around COVID-19. Over to you, Mohammed.
Well, thank you, Monsef, and thanks to colleagues attending the webinar. Now, very interesting conversation, and what is remarkable is that me and Sebastian being on this side of the panel, I think he alluded to it, the sort of collaboration AFDB has with EcoBanks tells it all in terms of the years that we've been working together and the various, facility we provided to them. Monsef, your question is related how we see, things evolving in the future, how we intend to play really a meaningful role in the coming weeks and months, if I can say. Before I get to that, I will just maybe set the stage, really give you an understanding what the bank has been doing in terms of trade finance, in terms of really supporting African financial institutions before COVID, during COVID, and then where we're going and what is really new, what is exciting. We have a lot of new things coming. So in terms of really providing support to African financial institutions in terms of financing and guarantees, and also maybe on other aspects that we have not touched, I will come back to on later. So the bank has been working with more than 345 financial institutions across the continent. And the bank has been covering more than 44 continents with close to 5 billion of approval in the very last recent year, and supporting more than 7 billion in terms of trade finance. And during the COVID time, the bank has put in place a very significant, actually, facility response of 10 billion, which was covering both the sovereign and non-sovereign. Close to 1.5 billion was intended to private sector and then to trade finance and financial institutions, in addition to the ongoing and sort of risk participation agreement we had with the global banks, which was close to 500 million USD. So just shows you in terms of magnitude what the bank has been doing and what the bank has done during the COVID era. And what was interesting also is to see the bank really deploy those facilities, some of these solutions, in a very, very limited time by, streamlining its process to respond to the market needs. In terms of the future, what we intend to do, of course, we've been listening to the market. We've been, of course, as collaborating with other institutions like yourself to really go the market and to see where the weaknesses are, what are the main concerns. And of course, it came down to the sort of risk participation agreement we used to provide, where the bank used to take up to 50% risk in the transactions. We know that in some countries, in some LICs, that 50% is not enough, or even it will not help global bank come there. So the bank has very recently, just yesterday, the FDB board has approved the transaction guarantee program, which will allow us to provide up to 100% in terms of guarantee, specifically in those LICs, specifically supporting those local banks that don't have maybe any correspondent that provide them confirmation lines. And in addition to that, in terms of selectivity criteria, the SMEs has been always something very critical, very important in terms of what we're doing. Sectors also has been very important, always in line with the high five, the key sector that the bank wanted to support. So we've been engaging with institutions like EcoBank in initiatives called AFAWA, where we want to really support SMEs and specifically women-led SMEs. So basically what's coming in the next weeks or months will be the direct guarantee. It is really a game changer for us, where we'll be able to provide up to 100% in terms of covering some of these risks African institutions are taking in corporate and SMEs. Of course, we'll keep also continuing the work we'll be doing in terms of capacity building of some of these institutions, because when we talk about the lack of financing to SMEs, as some of the colleagues have mentioned, it's not always the liquidity the issue, but it's the whole environment in which these SMEs are operating. The bank has in place some of this program, the SMEs program, where we provide a lot of capacity building to those banks and to those SMEs to be able to sort of bridge some of this misunderstanding in terms of perception of risk when it comes to the assessing SMEs. Of course, the bank will continue also to do some of the studies in report we do in terms of providing data on trade finance, the gaps, and what are the key issues, what are the real issues. We talk a lot about risk perception, and that perception is maybe most of the time due to the lack of information and data in the continent. And as we see, everyone was thinking with COVID, things will collapse in Africa. That is not happening. The recent webinar we attended with the Standard & Poor's were really showing that financial institutions are doing quite well, malgré the situation. And the continent is really showing some sort of, strength, and we need to build on that with all this initiative and with all what has been said by colleagues. I think we'll get there by collaborating and collaborating with institutions like EcoBank and many other local financial institutions. So basically that will be what is coming in the next month and next week, inshallah. I'll leave it there, Monsir.
Thank you so much, Mohamedou. Again, thank you for this ray of sunshine bestowed upon us. So thank you very much to all. I'm very mindful of the time. I understand that we've been trying to constrain the responses. We had planned Wambui maybe for a quick Q&A session at this point, and potentially maybe having some additional comments from the panelists. I guess it's time for me to hand it over to you and thank all our panelists for their time and insights.
No, sure. Thank you so much, Monsef, and thank you to every single panelist. It's been a fantastic discussion. We've got a few comments as well as some questions. And what I am thinking of doing is, instead of going straight into the next part, which was going to be the summary, let me rather do that at the end. So in terms of comments, and then raise a couple of questions that the attendees have asked, given that we have about 15 minutes or so. So some comments we've received one from Asuman Usabiamana, who says that there is goodwill of different partners in countries' economy to flow cash in economy, like central banks are reducing repo rates, or development banks are putting in place some special funds to commercial banks to lend to SMEs. So I guess that is a good thing. There's a question here specifically for, for Sebastian and Mohamedou. So this is from Abda El Mahdi, and he's from Sudan, where MDBs are almost absent in terms of financing for SMEs, whether in trade or other sectors. Commercial banks are even shyer. What can be done to get MDBs more engaged in the country while taking into account the debt arrears situation? And I think the main point here, I would just like to emphasize, partly also from this, is also a question that I would like Jane to answer, which is that, so we've heard about all these really fantastic initiatives that the MDBs are putting forward, but the real question is, how do you really get it to trickle down really to the SME who really needs it? So I would like to hear from Sebastian, from Mohamedou, and also from Jane.
Can I come in, Mohamedou, here?
Yes, go ahead.
Yeah. No, very, very interesting question, referring to challenges MDBs in general, including AFDB, are having to provide some of these facilities in low-income countries, countries like Sudan. In the AFDB situation, of course, we cover the entire 54 African countries. And then, as I mentioned it earlier, we do provide funded facilities. For those funded facilities, we do cover LICs. We have done Zimbabwe, Liberia, Burkina Faso, Mali, and all of these institutions, when they come to see us, we assess them as a standalone institution, if they are credit worthy, and then if the sort of sector, the sort of SMEs they are supporting are really critical for the economy, we do it. So we cover all the countries, including LICs. In terms of the risk participation and guarantees we provided, there we face some challenges in LICs, because the way that product is structured is that we sort of follow the 14 of international commercial banks. So we go to them in the countries where they are present already, so just to provide them sort of capital relief. But I just mentioned that the AFDB board yesterday have approved the direct guarantees. The direct guarantees are really meant to specifically for us to focus on those LICs, because we'll be able to provide up to 100% guarantee. That means if a commercial bank was not, let's say, willing to cover Sudan for credit risk or some of these issues, we will be in a position maybe to convince them to come with us to Sudan, so that we'll give them the sort of comfort they need to start doing business there and to see themselves by their eyes, to realize that maybe the sort of the risk that they're perceiving is not what it is. And then from there, we believe with this relationship, we will help them really remain in Sudan and do more business there. So this is the sort of things we're having for SMEs, and I'm sorry, for LICs in terms of guarantees. For SMEs, the same situation also. We have, like I said, an SME program where we work with, I don't like to say that small institution, I mean local banks are really not being able to source any funding in the international market. So we do many of these facilities in LICs, of course, like I said earlier, Liberia, Mauritania, Burkina Faso, and Sierra Leone, and so on. So in the case of Sudan, I think we should be able to come there very soon with our direct guarantees.
Yeah, thank you. And
Sebastian, hold on. There is actually, I want to group a question for you, which is, it's very exciting. Thank you, EcoBank. It's exciting to know about your initiative of 100,000 SMEs initiative. What is the selection criteria for SMEs to benefit from the initiative? Which region of Africa?
Look, I think there's a lot of information that I can make available after the webinar on this, and perhaps I can route it through this particular medium, because there are multiple criteria, and I can't go into all of them here, but we're very keen to sign up more names, so I'll make that information available. In spite of the Sudan question, you remember that I mentioned 2 points. I spoke about the fact that in certain countries in Africa, it looks as if there are very few MDBs that have been left on their own to support those countries because there is a perception, and in many cases, a reality, that they're very difficult countries. There was also a point I made where it's necessary for some of the MDBs to pair up together. So if you have an EADB, which is within the East Africa region, knows the ground and the territory in detail, and is pairing up, for example, with an AFDB or an AfriExim or an ITFC, you've got a winning partnership there to be able to support institutions in countries like Sudan much better than we've been able to do in the past. Now, I know Sudan itself has had a bit of a difficult history with a long history of sanctions and all of that, but I see it as a truly emerging country now, and we need to put some of these initiatives in place to actually provide more support, even though I do know that the ADB does do a little bit of work there.
Great, great, great. Thanks. Very good point there about collaboration. I have one really good question, and I think I'll pose this to Theobald as well as Mubarak. There is a puzzle, and actually Nuru, sorry, if you can hear. The question is, there is a puzzle of non-paid loans by MSMEs to banks due to low or no sales. Now the economy has to revive, and loans have to be lent to MSMEs, which cannot pay in short time, well, in time due to lack of viable purchasing power of households. So given the fact that demand has gone down, because I guess a lot of people have also lost their jobs, and so purchasing power is down. How do we come out of this challenge? How do you see the financial sector addressing this challenge?
Thanks. If I can go first, I think obviously the specifics of each borrower or each customer will be different, but ideally we should, as banks, be ready to support these customers to weather this situation. We have been doing that as an institution at NBC. We have a program where we give these customers payment holidays, payment moratoriums, depending on the circumstances. We restructure their loans to give them the time and to give them the opportunity as well to conserve the liquidity that they need to be able to weather the situation. So I would say it should be dependent on the specific circumstances of the customers, but it is something that commercial banks I see are actually doing. But I think linking that as well to the support that the MDBs could provide is where, for example, a buyback of NPLs, for example, non-performing loans, stuff like that, or guarantees to support the restructuring efforts of the commercial banks through this pandemic situation. Thank you.
Great, great. Thank you so much, Theo. Very insightful and heartening to hear that the banks are not shying away. Mubarak?
Okay, thank you very much. Like I mentioned at the beginning, when it all started, the approach we took to it was to speak to our customers. For us, the way to walk out of the problem is to bring the counterparties in the problem to see how we both see it or how we all see it, and then how do we work our way out of it. As Theobald mentioned, every customer's challenge is mostly specific. So there may not be one solution that fits all of it. So what we see or what we have seen is that the problem is immediate, okay? But we are looking at a future that is looking brighter. So how then do we move forward? We think, or what we have done is to keep the bicycle rolling so that we all don't fall off the bicycle. And that means by keeping the financing in there so that life can go on. Now, what that does is that it gives everybody confidence. Because if you're the financier that is supposed to be the expert, if you freeze, then everybody else freezes, and then we all get into trouble. So our approach has been to, like I said, talk to our customers, look at the receivables that are coming to see how to manage those, and then we craft the specific solution according to the customer, but more importantly, to keep the financing going so that they can attend to the needs and then to be able to take care of business. So this is how we have handled it. And then we also took note of the opportunities that came with this. So there are quite a few programs that we hopefully will launch soon. The other thing also is, as Sebastian mentioned, and also I think Mohamedou mentioned, is the strengthening of partnerships. For MDBs particularly, we are a little bit far away from the real action. So the importance to partner with local financial institutions that know the customer on an everyday basis is crucial. Based on this, we are all able to sort of share the risk and find the solutions that can give us all a kind of win-win. So for me, I think that there are solutions that can be worked out mostly, but we may just call on all our partners and all of the people on the chain to have some sort of flexibility to see these scenarios as an opportunity for us to do things maybe a little bit differently. So I think if we take that approach without panicking and being constructive and innovative, despite what looks like gloom, the future actually can be quite good for everyone. Thank you.
Sure, thank you. Thank you so much. We are kind of running out of time now. I think unfortunately we will have to close our discussion. I'm going to invite Monsef to just tell us, give us the last word and tell us what is next. Where do we go from here?
Thank you. Thank you. Thanks for giving me the last word. Look, I think from what I'm hearing even today, this situation, I think we all still trying to understand what's happening. We are responding. There's enormous effort that are being done by government, by MDBs, by banks, by individual entrepreneurs, and we've heard some of the very touching stories today. I think we all still learning how to respond to this situation. If I want to insist on one point that would come out of today's session, would be that in that situation, this is really where we need to come together and make sure that we continue this sort of forum where we share the information. We may not have all the answers, but I think it's important that everyone shares those stories and that we have a view on the ground. So this is almost a formal, call to my colleagues from other MDBs. I think bankers here and maybe some people that might be interested to continue this dialogue and maybe having, more of those pulse check, maybe publishing some more report on the situation, really having a dashboard of the evolving situation on the ground and trying to be advocate for what could be done at all levels, whether it's at the high level MDBs, World Bank level, or down below at the banks or at the entrepreneurs or the Women Empowered Fund at the SME level. And hopefully this group and others will hear more about this joint and collaborative efforts that we're trying to maintain across the various actors. So thank you to all, and hopefully we'll talk again very soon.
Great. Thank you so much. I definitely think that it's really important that we keep tabs on the situation, especially because, I think until a vaccine is found, we don't really know how life is going to unfold for the next few years and whether this situation is going to be with us for 6 months, another year, 3 years, we really don't know it. And it's really difficult to plan. So certainly pulse checks are welcome. and will help us keep an eye on the ground. I think from my end, what I really had was, despite all the gloom that is there in the world, there are definitely some really good rays of hope, sparkles, and the best news is that the financial sector is not shying away from addressing this challenge and is really meeting this head on. One of the things that really came through is that MDBs have a role to play. And it's really important now because when we think about the other biggest financial or global economic crisis that has ever happened, bigger than this, probably before MDBs came into existence. And what's really making the difference now is that we have MDBs that can help and respond to this situation and to this global crisis. And then lastly, also the need for partnerships, for collaboration has been reiterated. And I think there is no better way to end this except to make sure that we continue to work together to address and to solve this, this challenge that is ahead of us. In terms of saying goodbye, before we close, I want to say a very big thank you to the panelists for giving us your time, making yourselves available. Thank you also for sharing the instruments that you have available to support the financial sector. This is part of the work that we do at Making Finance Work for Africa. And I would also like to thank the attendees who also made time, and we hope that you have benefited. And last but not least, to thank the team at the Making Finance Work for Africa Secretariat for all their logistical support and making sure that we have a really successful webinar. So thank you, everyone. And I'm now going to close this meeting. I wish you all a wonderful rest of the day. Bye-bye.
Thank you, Wambui.